Today we are going over insurance, life insurance, whole life. We're going to blow the door open.
Everybody's favorite topics.
Yeah, but you know what? I had a conversation with Ryan just a second ago, and he said, should I be getting life insurance? I thought you always said don't do it. So there is not a better guest than you to go over this topic. So first off, can you briefly cover the difference between life insurance and then whole life insurance? So term and whole life.
Yeah. Well, I mean, the first clarification is whole life is a product type, where term is like a niche of the market where you're solving for a certain period of time. Whole life is a product within, I would say, permanent insurance niche of the market, right? So whole life is just a product. It's usually driven by mutual company carriers that have the sales agents to offer them. So think New York Life, Mass Mutual, Northwestern Mutual, those types of companies that may have internal salespeople, and that's their bread and butter to sell. But from a high level, term is going to be, you're covering a set amount of years. It's going to be very inexpensive. It's bridging the gap from now until, say, your retirement age. It's there to protect if, God forbid, something happens to you early. There's money there for your spouse, for your kids, pay off your mortgage, replace any income that might be lost, bridge that gap.
Okay, so if you're not financially free yet, or you're not retired yet, this is the bridge in case something happens to you. You can have money that comes in that might help the family get you to the point of retirement.
In simplest terms, yeah. So like if you're putting together a financial plan and you're saying, okay, I need to have this much money so that when I'm 65, there's enough assets there that we can live off for the next 20, 30 years without having to work anymore, and all of our debts are paid off, our kids are financially independent. If something happens before you get there, the life insurance policy is the thing that fulfills that financial plan to allow the surviving spouse or kids to still reach those goals without you being around.
Okay, and so then what's whole life?
So whole life, are we talking whole life as the product or whole life meaning permanent life insurance?
Let's go over both of them.
Okay.
I want every listener to walk away from this actually having an understanding of what insurance is.
Yeah.
Because I feel like everyone's confused.
Yeah.
No one knows what it is. Even those that buy it are like, I don't know what I just got.
Yeah.
Exactly.
Yeah. So I'll start by saying permanent insurance, which just means instead of term where it's covering you from now until the end of a term period, 10, 20, 30 years for most stuff, a permanent policy is going to be something that's covering you until you're 100, 120 years old, hypothetically, on some ledgers of how the insurance company is contractually saying, we're going to cover you for this period of time so long as you pay the premiums.
Okay, so
right?
they're going to cover you for your whole life.
So you know that assuming you pay the premiums, the policy's in good shape, that whether it's in 5 years or 50 years from now, the death benefit you signed up for is going to be there for your beneficiaries. Okay. It's not something like term that will expire someday. So when it comes to permanent options, it runs the gamut. And primarily, you'll hear of whole life or universal life as the two main product chassis for permanent insurance. And within those, you have different structures on a whole life chassis or a universal life chassis. On universal life, you can be as simple as I want a GUL, a guaranteed universal life policy. Think of it like a term policy, but it's in place for life. The premium's guaranteed to never change. There's virtually no cash value. And you're just paying a premium in exchange for a guaranteed death benefit for the rest of your life. You can do what's called a current assumption UL. Every carrier's got a general account. I know, I'm getting nerdy here, but...
Get nerdy. I want people to know what they're doing.
It's just an education thing.
Yep.
So current assumption UL is going to be every carrier's got their general account earnings. Let's say it's between 4 and 6%. That's going to credit your policy every year, and they're going to solve the premium based on what they think that credit's going to be over the course of life. And if that rate goes down, the crediting rate, you might have to pay more premium someday. If that rate goes up, you might have to pay, or you could pay less premium.
Got it.
Then that gets more nuanced where you start to use it for cash value purposes, or there's indexed universal life, and then there's variable universal life. Variable has market participation, where you might be able to invest in mutual funds and stuff within that life insurance wrapper. Indexed is still considered a fixed product. You don't need to be securities licensed to sell it. But there is cash value that's being tied towards certain index markers. Think like an S&P 500 index with a floor and a cap.
Okay, so this is where people say, I am investing or I'm using a life insurance policy to invest.
On those chassis, those would be the ones that they would do. Either an index universal life, whole life, or a variable universal life. That's the direction they would go if somebody was saying, look, I want to invest in life insurance or in a life insurance policy, overfund it for, tax-free retirement income, that side of things.
Okay, so then why are advisors pushing these whole life policies, at least the investment ones, so hard?
Well, I would say that the financial advisory world, if you put every financial advisor in a bucket, you're going to see a pendulum of advisors that are saying they're financial advisors, but I'll just say they're tied to a mutual company where they're motivated. Their financial toolbox always includes life insurance, and they will say that this is the best use of your asset portfolio and diversifying into that.
Okay.
Then you'll get what are called fee-only advisors, where they don't get any compensation off life insurance, and you'll see that they're very much against any life insurance in somebody's portfolio as a whole, because from an investment perspective, you can show on paper most of the time that if you invest in a market, you'll probably see a better rate of return over the long haul compared to a life insurance contract. So the people that say it's the best investment ever, I would say usually are motivated because that's one of their few tools in their toolbox. And that's how they're going to make the most money off of pitching it for that purpose.
Okay, so when you say those are the most common tools in their toolbox, you mean that's the thing they're selling, and the thing they're selling, this is their opportunity to make the most money?
Yeah, so or they're, within their compensation structure of whatever company they're with, there might be higher levels of compensation if they sell enough policies. And it's not always like an amount of premium. Sometimes it's literally a contract. How many applications have you gotten in the door? We need 30 applications this month to get, a higher level of commission on those products. And that's when you see, look, I want to sell a policy to you, your wife, and your 3 kids. And if you know anybody else, I want to talk to them too. That's where it gets a little messy.
Okay, how lucrative is it to sell insurance?
It can be very lucrative. So life insurance primarily.
Okay, yeah, go ahead.
Because that's where my focus is.
Yeah.
So life insurance primarily is what's called a heaped commission payment for the majority of the time, which just means you pay a premium and your agent, on whatever that premium is, depending on the product, but is from a high level going to make anywhere from 50 to 100% of that first premium as their commission.
Dang.
So there's nuances there. And, some of those cash value might have what's called a target premium instead of just you're taking if it's on a 10 pay structure where you're trying to pay it up in 10 years and build all this cash value, it's not going to be the same commission usually as that, one premium. It might be a little less,
right,
but they'll get paid perfectly well. The challenge there is it makes it really transactional, right? Whoever's selling that policy, you may not ever hear from again because they made their money and they're less motivated to stay in touch with you. And that's a friction point within our industry, I'd say, and probably why a lot of other professionals would say that life insurance is just a little bit of a challenging industry to trust as financial tools.
Yeah. What is it just me, or why is every financial... No, let me say this differently. Why does it seem like every insurance product is so confusing to understand?
Because it becomes less about the product and more about the sale.
That's
right?
what it is?
Yeah, because if I can sell you on a fear that you will die and you have to utilize this product in order to make sure that your family is taken care of, that becomes the focal point of the conversation. The vehicle that I use to get you there, I can structure it any way that I want to, whether it's term, whole life, VUL, IUL, whatever the case may be. And so all of these layers of complexity, I, as a former CFP, had a hard time following and tracking all of them myself.
Oh, good. So it's not just me.
No, it was very complicated. It's very nuanced. There's a lot of things that go into it, and it's very hard to track. But you spend less time there, and you spend more time on tax benefit, the protection for the family, all these things. You pull on the emotional strings of your client, and now you're getting them to subscribe to the thing it is that you want them to buy.
Do you only sell term?
No, I sell everything.
You sell everything?
Yeah.
All right. So you're selling, if you're going to sell me an investment, right? Universal life.
You mean sell you a policy built for accumulation purposes?
Yes.
Because I would never call life insurance an investment. That's where you get in trouble.
Interesting.
Yeah.
Okay. So fair. Let's say you are going to sell me an index or universal index life. Is that what it is? UIL?
Indexed universal life.
Index universal life. So you're going to sell me an index universal life policy.
Yeah.
How are you selling that to me?
I mean,
What are going to be the things that make me say yes?
you want me to sell it to you as if I think it's the best thing for you, or because I may not always agree that I think it's the best thing for somebody, just
Okay.
because if you're in a lot of circumstances, people are selling it for the purposes of investment, and they're taking dollars from other areas of your portfolio that I would argue might be better suited in other areas. And they're over allocating towards a life insurance bucket for that
Right.
purpose. And they'll show you a proposal that has unbelievable income streams that never end. And they say, look, it's tax-free retirement, it's a Roth IRA on steroids, all of that, right?
So that
So
right
I hear
there-
that and I go, that sounds cool.
Well, but that right there separates him from a lot of the insurance salesmen that I've come in contact with, which is he's going through a method of identifying what is it that you're trying to achieve, and then let me provide a product that will fit what your goals are. Whereas there's unfortunately a lot of people in the industry that have a intent on what it is that they want to sell, and then they will try to pull on the pieces of information to make it fit in that box.
So is this like your infinite banking and all that stuff?
Yeah, I mean, well, infinite banking's a little different, but they all tie in, right? So
Great, because I want to walk away from this understanding
infinite banking.
all of it. Yes.
So I mean,
But hang on, I want to go back to
Yeah.
I want to go back to the
Yeah,
IUL.
you haven't finished being sold yet.
You want me to sell you?
You just said two things, and I went, "Ooh, this sounds good."
Yeah.
A Roth on steroids and tax-free wealth.
yeah.
Okay, why don't I want
Let
that?
me role play, and I'll sell you a typical sales structure.
Yeah, let's go.
So, right now you're making a good living. You've already maxed out your retirement accounts, and you're looking for other areas. And look, we've got, what is it, 20 plus trillion, $30 trillion of debt as a country. Where do you think the tax code's going? Or taxes are probably going up over the next 10 decades,
Correct.
or 3 decades.
Yeah.
So if that's the case, do you want to be contributing to these, qualified plans where it's pre-tax dollars and you pay on a bigger, for some people they say, do you want to pay taxes on an acorn or an oak tree?
Right.
That's the imagery, right? So if you pay into your 401k and it's pre-tax, and then when you pull it out, what are those tax rates going to be when you're in retirement? They could be significantly higher. So how do you preserve that? Well, let's look at ways of doing that. If you don't qualify for a Roth, then
Meaning you make too much money.
meaning you make too much money. Then you look at other areas like life insurance. And life insurance is going to be there where you can overfund a policy. It'll grow tax deferred. And when you go to take money out, your basis is always tax-free if you withdraw your basis first. And then you can borrow against the policy, which may have a fixed loan rate or some favorable loan rate compared to maybe what a commercial bank might be offering for a loan. But you're borrowing against your contract to allow it to still be tax-free. Like, you don't have to pay taxes on a loan.
Right.
And now you can essentially build that pool of funds and start to borrow against it in your later years to offset the lifestyle costs and not have to pay taxes along the way.
Okay, so what's like a realistic return that you can make out of this thing?
Realistically is, I think realistic is in the 4 to 6, maybe 7% range on, I'll say, whole life and IUL. You might be able to get a little bigger on a variable chassis. If you just think about risk in general, usually on an investment, the more risk you take, the higher probability of, a higher rate of return.
Right.
But there's also potential risk on the downside, right? So for a whole life, it's pretty safe. Like you're investing in a company that's been around for 150 years, and you're hoping that they pay you a dividend every year, which they historically have done, which is truly just a return of excess premium you've paid.
Mm-hmm.
For an index product, it might be slightly more risky, but you might have a slightly better rate of return because maybe you're investing in a S&P index that over time might offer a slightly higher rate of return. Variable, you're in full market participation, which is great. You might get a better rate of return long term, but you just need to be more careful when you do draw against it, because if you've leveraged your policy out where you've borrowed against it so much and there's a correction and your cash value depletes and you have an outstanding loan balance that's too high and you lapse it, now all of a sudden every dollar you've taken that's over your basis is taxed at income, and you might have a really unfortunate tax bill.
So this is why it gets confusing for a lot of people. In what he just covered, you talked about an insurance policy, an investment strategy, a tax strategy, and a lending arm.
Yeah.
All encompassed into one.
Yeah.
And they all impact each other in one way, shape, or form, depending on how you utilize it. And that's where a lot of people get lost.
And if I wanted to sell it to you,
Yeah.
I would say, look, you can contribute, I'll say $20,000 a year to this thing for 10 years. You put 200 grand of your after-tax dollars in for 10 years. And we wait until you're 65 years old. We let that thing bake. And then I'm going to start borrowing against that policy. And I'm going to show you on a ledger that now you can take out, I'll just say $200,000 a year for the rest of your life.
Right.
So you put in 200 grand and you're getting back out not only 200 grand for 10 years, but for the rest of your life. It might even be more. You know, there's illustration calculations here that maybe it's 400 grand for the rest of your life. On paper, if you don't know what you're looking at, you think, how could I ever not do this? This is the smartest decision I ever made. You're saying I can make 400 grand a year or a month, 400 grand a year and not have to pay taxes on it. And all I did was contribute for 10 years. It looks great.
Yeah. So what are people missing?
So you need to understand, number one, what's the underlying, I'll say, investment structure within that contract. If it's whole life, you're investing in the company and getting paid a dividend. If it's an IUL, you're investing in index options within the contract that carrier has allowed for that product. Some of them are well known, like an S&P 500. Some of them are engineered specifically for that carrier's product, and it's a volatility controlled index. That there's regulations that allow you to illustrate a crediting rate. What these allow you to do is illustrate a potentially higher crediting rate because it's back tested. What people don't know is this crediting rate off this index, they're back testing 25 hypothetical years, and that index might have only been around for 4 years. It might be brand new. They're saying that, look, we've built this today based on the last 25 years, but we're going to only put it in place today, and so many of those on the index products have underperformed, but they allow you to illustrate great returns.
Ooh.
And that's where it gets complicated.
Yeah.
Because most people are not looking at, hey, what is this underlying index that you're allocating my excess premium to and my account value? Nobody's asking that question, and most agents are not actually presenting the various options within these carriers and products. They just assume, look, I've got a floor of 0 and a cap or maybe an uncapped amount, and they think this is amazing. I can never lose my money, and it's only upside, and if I look at the historical, it's amazing.
Talk about the cap for a second, if you don't mind.
Yeah.
Because
So
that's one that a lot of people are not aware of.
yeah, so and this is primarily for index products. So they'll get pitched as there's a floor of 0 and there's a cap of some sort on the top.
Like can't make past 7%.
Yeah, so let's just say the S&P 500, and we'll keep the numbers easy. There's a floor of 0, so if the market S&P 500 index, and it's point to point. So today, if you go 1 year from today, what's the S&P 500 index value today? What is it 1 year from now? If it's below where it was day one, then you would get credited 0. You don't lose any, you don't get credited any negative rate. Versus if it returns a positive 20%, you're probably capped at something around 10% today. So you don't capture all of the upside, but you're protected on the downside. Now, what gets more interesting, and those caps are non-guaranteed, by the way. So they're just assumed based on what is the carrier earning off of their general account. They're going to go to an investment banking company most of the time and say, hey, buy options. What can we afford with the amount of money we have that you've paid in? What are the cost of those caps today? And that cap this year might be 10, and next year it might be 9. Who knows where it's going to go in the future?
So it floats.
It flows every
changes.
year.
Wow.
Exactly.
Okay.
Yeah. So that upside is always non-guaranteed. The downside is usually a guaranteed base of 0.
Usually.
Yeah. No, I mean, on an index product, it
You're not going
typically
to lose
is.
money.
Yeah, there's so many nuances here. So then you get carriers that offer like, hey, if you want to add, I'll say a performance fee, and maybe there's a 2% extra fee on top of it. Now it gives the carrier more leverage to go buy a bigger cap. And maybe now instead of a 10, you have a 14% cap, but you're going to get charged 2 points on it on the back end. So if you get a net 0, now it's really more like a net -2, right? So you're factoring in those fees. All that to be said, when you look at an illustration on any of these things, the problem is everything's linear. If I wanted to show 6.5% rate of return, it's showing that every single year. And let's say in the years that I start borrowing money and it's a loan, even if it's a fixed loan rate of 5%, then you're arbitraging based on the crediting rate of that index that we can show linearly and that loan rate. Now, there's been regulations that have limited that, and it's supposed to be a max of a 0.5 point between the positive credit and the loan. But carriers are working their ways around it that still are abiding by the rules of the regulatory environment, but they're creating on the illustration maybe an arbitrage of 1.5% still. So when you can show linearly a crediting rate that's always 1.5% higher than whatever your loan value is, you have an income stream that can illustrate for the rest of your life. You're never going to lose money.
So am I hearing this right? This would be like if we were presenting a deal to an investor and that deal could not pay more than a 6% yield. And we're showing them an illustration that they can actually make 9. Is that what's happening here? Like my asset will not generate more than 7% cash on cash.
Well,
and I'm like, oh no, you'll make 9, all good. That's what they're doing in the insurance world?
Well, I don't know if it's the same hypothetical because you're investing even on an index product in an index. So everything's hypothetical. It's not a fixed, it's not a 6% rate of return.
Right.
Some years in reality, I'll say 7 out of 10 years, you're going to get a positive credit. And 5 of those 10 years, you're going to cap out where the S&P is going to hit 10. 3 of those years, though, you're going to earn a 0, just historically speaking. So, I can show you on average that you might earn 6% linearly, but in reality, it's going to be 10%, 7%, 10%, 0, that sort of thing. And over time, it might average out to that, but that's very different than a linear 6%. When you're borrowing money against the policy, that's where leverage gets to be really dangerous within a contract.
Let me pose a scenario and tell me where it's wrong.
Yes.
Insurance carrier issues, let's say $10 million in premiums. That $10 million goes into the index world. And over the course of 30 years, that $10 million now became $100 million in earnings over a long period of time, right? The $10 million basis invested over the 30 years now became $100 million. We're using arbitrary numbers. Yeah. That's $90 million of gain on the original $10 million investment, right? Because of the caps, the recipients of the policies are, let's say, limited to only receiving $30 million. Who gets that extra 60?
I'm trying to understand correctly here. So you're saying in a hypothetical side account, you're investing 10 million and that could grow to 100 million.
Right.
Or your policy is only getting credited.
Who's capturing the margin between the earnings and the cap that has to be paid out to the policyholder?
It wouldn't be the carrier in this case, actually. So it's their index options. So you're going to an investment banking group that's going to allow you to purchase these things, and the carrier is going to still earn their general account to earnings they're not going to capture the upside where they're going to make a ton of money. It might be the investment banking side, but it's
That
not.
sounds like a banker move.
Yeah, it's not going to be anything to do with the insurance carrier. Your policy will get credited whatever it's earned based on the parameters of your cap and floor that the carrier is offering.
Right.
Who gets the excess? I'm not sure. I would imagine it's the ones taking on the risk. And the carriers are not the ones taking on the risk. They're just going and buying. They're third partying that risk out to offer that floor and cap as just a different structure within the policy owners.
For everybody who says that insurance is the way to invest, the people selling it, how many of them do you actually think use that tool for themselves? Any idea?
Yeah. I mean, I don't have a great idea. I would imagine half or maybe over half.
Half.
Yeah. I mean, the
That's
problem.
okay. That's
the,
more than I thought.
the problem is, you have a lot of insurance agents that get in the industry young or new, right? And they are told this by, I'll say, their management team of like, hey, these are the best. These are the Ross on steroids. This is what you want to get to.
Yeah.
And the problem is there's so many of these firms. They're almost turning into multi-level marketing type structures now. And you get kids right out of college that are like, oh, sweet, I can go make commission on these things and sell them. And they go sell them to all their friends, and they're putting $200 a month into these things. That's a horrible use of those funds. And those same agents that are selling it are out of the industry within 2 or 3 years. And somebody, the policyholder, is not going to make a whole lot of money on their cash value. And at some point, they come across my desk or some other agent's desk, and they're like, dude, you were sold a bill of goods. This is not an investment that you should have otherwise been putting towards a Roth or putting towards other things.
Okay, so is that why there's families that have been paying for decades that never actually get a payout of an insurance product? Does that happen?
For the most part, I would say no on a life insurance structure.
Okay, good.
That would
Yeah.
probably happen more on term if they go beyond the term.
Oh, so that only happens with term.
No, I mean,
Like there's
Life
not a
is-
scenario where somebody sells you an index policy that you're putting money in every month and you never get to draw from it or you never make a return. That doesn't happen.
so what happens, I'll say on the downside,
Yeah.
is if somebody's funding a policy like that and the crediting rate isn't living up to what you expected it to be when you signed on board, or if you're underfunding the policy and over time the charges have gotten higher, or it's underperformed, that's going to create more negative influence on the fees within the contract. And then, in 20 years, if you haven't managed it and changed your premium, you might receive a letter saying, hey, you need more premium to keep your policy in place. All the while you thought, man, I thought this was great.
Right.
So this isn't hypothetical. I had a client.
Shoot. This is real life.
So I was sent this client to review their policies from a wealth management group locally that sends me their clients. And upon review, this guy had a whole life contract, put it in place in the late 80s. The dividend rates at that time were 10 to 12%. Interest rates were high. Obviously, interest rates have come down a lot since then. The client never reviewed his contract. He built it in a way that he was paying a premium based off the assumption of what that crediting rate was. When I got to it, and this was maybe 7-8 years ago now, but when I reviewed it, I saw that the way that it was structured was there was an automatic premium loan withdrawal that was part of the contract that he was never aware of. So the underfunded amount of the premium that he wasn't paying was borrowing against the cash value internally, and he wasn't aware of it. And when I reviewed it, the contract had, the account value was like somewhere in the million range, but the loan against it was somewhere in the 750,000 range, and the basis of the policy was like 300,000. So, there's a $400,000 gain within this contract that's already been borrowed against. And now he's in a position that he didn't realize he was in. And if he doesn't change anything or start to offset these costs, in 10 years, the policy would lapse and he would have otherwise received a 1099 out of nowhere for 6 figures, and he would have had to pay taxes on that, and he would never have known. And all of that is due to what were the assumptions when we first put this in place, and him never managing the contract along the way. So not only would he lose his life insurance, but he would have to pay gains on everything there.
Out of curiosity, what was his death benefit on that policy? Do you remember?
It wasn't high. No, it was. I mean, it was somewhere in the $1 million to $2 million range. But after the loan and everything, it was mid to high 6 figures. It wasn't something overly substantial.
Do you recall roughly what the annual premium was?
I don't.
No.
Sorry.
But
It's been a while.
I bet it was high.
Yeah.
It was a high premium.
Yeah.
And if the intent of life insurance is that you have a lump sum amount that's getting paid to your spouse upon death so that they're going to be okay, they can pay off the house, take care of the kids, that death benefit just went way down because of how this vehicle works. And the amount of money that was paid into the policy in order to get the death benefit was also very expensive. And this is why there's such a big argument to be made that term is the way to go, because you are paying a lot less and getting a much larger death benefit. The risk is if you live beyond the term, which let's hope we all do, then all that premium was for nothing. But again, it just depends on which lens do you look through insurance in making the decision. Is it a vehicle for investment in taxes, or is it a vehicle for catastrophic loss to take care of my loved ones if something happens to me?
But in the defense of this particular client and that structure, I don't know whether or not originally it was like, hey, this is in your best interest, or this was sold for accumulation purposes,
right?
Or if it was sold just as permanent life insurance with the benefit of having cash value. I wasn't there when that conversation happened. To me, the biggest takeaway is these things change over time. And it's up to the policy owner and hopefully the agent or the financial advisor selling it to manage them properly. And if they would have managed it as rates came down, the pain would have been far less if they just would have checked in on it on a regular basis than where it left him when I saw it, 25 years after the fact.
So for somebody who's going to be investing in an insurance policy, what they need to be looking for is growing their wealth, pulling it out tax-free, having a death benefit, and then using leverage. I guess the leverage not. Do I need to be sold on those 3 things to do this?
To use life insurance as an investment vehicle?
Yeah.
You mean?
Like for me, I don't. The thing that I don't understand is either use it as an investment vehicle or don't.
Yeah.
Right? I've always taken the stance of give me the cheap term and let me go invest.
Yeah.
But what I like, and maybe I should poise it this way, if I want to grow my wealth and I don't want to pay taxes, what insurance product am I going into, if any?
Yeah, I mean, so the most important thing is you need to structure it properly. And what I mean by that, and everybody has this keyword, like, oh, if it's properly structured, you need to make sure that you're bringing the death benefit. So from a high level, whenever I'm talking to somebody about permanent insurance, you're structuring it for a purpose. It's either for death benefit, where I'm trying to pay the least amount of premium for the most amount of death benefit.
Okay.
Or I'm structuring it for accumulation purposes, where I'm trying to put as much premium as possible to keep it a life insurance contract for as little death benefit as possible. And within that, if you're trying to structure it for an investment, that's the area I would go. So number one, it would be how much do you want to put into this thing? And then let's make sure we can solve for the lowest possible death benefit so that, if there's $10,000 going in, how do we make it where 8,000 or 9,000 of that is going towards the account value that's going to grow instead of, a majority of that going towards fees and charges and cost of insurance things. So when you structure it properly, that's going to give you the best opportunity for success long term.
Right.
The one thing that I would be careful of, and this is where I think a lot of insurance agents get in trouble, is they sell it as an investment and then they show these distributions in retirement years that last forever. And there's different loan structures within the contract that allow you to illustrate it that way. I'm not a fan of that. If I ever had this conversation with you, I wouldn't show any distributions. I would be showing you, hey, here's a cash value policy that it's going to grow over time, and let's use conservative assumptions and understand what the underlying indexes are. Over time, if you structure this in a way, and when you get to 65 and you've funded it, if you don't need the money, it's a life insurance policy that will just continue to grow for your beneficiary someday. If you do need the money, you can always pull out your basis tax-free. So let's say when you are 65 and you want to go buy a vacation home, next to the beach, then you need $1 million and your cash value is $3 million, but your basis was $1 million, right? You can pull that $1 million out, go buy a home, and your policy will still have enough cash value there to go for life. If you're going to borrow against it, and this gets more like infinite banking structure.
Yeah, I want to talk about that.
Where when I want to go leverage this in a different way of, I've got an investment that might earn 12% on my money, and if I can borrow against my own insurance contract that I've overfunded for a lot of years, then I can go do that, and I don't have to be underwritten by a bank, and then I can go use that to buy whatever thing I've got and then try to repay that note over time. All of that requires a lot of management. It requires an understanding from the client of what the risks are when you borrow against your policy, and if things go sideways and how that could create a taxable event. It could mean you might need to put more premium in later. Like there's an ugly side of all of this that people never address.
Right.
And that's maybe where they get in trouble. But if I was ever going to sell you something, it would be something. I don't want you to have an expectation that you can pull money out for the rest of your life. It's literally a forced savings account on the side that if you get there, you could hypothetically surrender it all if you wanted to when you're retired and add it to your other investment pool if you don't need life insurance anymore.
Got it.
So it's not an income stream opportunity. It's an accumulation vehicle that you could tap into should you ever need it. But then it bodes the question of, okay, does this make sense in my overall financial plan? And is this a good use of diversification? And that's where it comes in. And for me, I like getting involved. Hey, who are your other fiduciary team members? Who's your financial advisor? Who's your CPA? Who's your estate planning attorney? Let's make sure we're all on board, because an insurance guy should never be the quarterback of a financial discussion. That's my opinion. And if I can get them on board, then we can all agree that it's probably worthwhile for that client to do. If I'm an insurance guy saying all your investment advisor and attorneys don't know what they're talking about, I'd be a little concerned.
Okay, so are you saying that if you don't have a full team helping you with your money and somebody's selling you insurance, there's a high chance that you're being sold a bill of goods that is not correct for you?
It's
like,
I don't want to say that's a blanket statement.
Yeah, but let me maybe give an analogy that will resonate with more people. It's like going to a cardiologist for your primary medical care needs instead of going to a general practitioner, right? So the quarterback in the medical space is your family doctor. And then if something pops up that requires a specialty, they get referred to the specialist. Orthopedist, cardiologist, urologist, whatever the case may be. You don't go to the specialist to solve the general issues. You go to the generalist, who will be the quarterback that's got, like your primary medical doctor. They know a little bit about cardiology. They know a little bit about orthopedics. They know enough to know this person requires the help of an expert in this field to complement everything else that's going on. And so who is that general quarterback going to be? To his point, should not be the insurance person, because they have a very specific niche that is just one aspect of an overall financial plan. It's not the all-encompassing financial plan. And so if you have the specialist driving the entire picture, you're not going to get what it is that you need out of it.
Got it.
And I would clarify, though, that that's specifically in relation to life insurance being used as an investment vehicle.
Yeah.
I think that I should be the quarterback, but I should be brought in by the team. But when it comes to life insurance for estate planning, which for me is the best use case of life insurance, now I know more than most advisors do when it comes to that structure, and I'll make sure I find the most suitable option with their involvement still. But I should be the one shopping the market, finding the best solution to figure out what is the lowest premium to fund that highest death benefit amount.
Yeah. Well, that seems like that's already what you're doing. Like knowing you have the relationships with the advisors that are
Yeah.
coming to you going, I have this client, I have this need. You are the guy to figure this out.
Yeah.
Correct? Okay, so I want to know about infinite banking because that seems like all the hype to make a lot of money and get rich.
Well,
What is up with infinite
What a
banking?
good buzzword. Infinite
I mean,
banking.
well, look, it's
Can you just explain it? Like what is infinite banking?
it's the idea. Well, it started on a whole life chassis.
Oh, I thought it started on TikTok. No, I'm just kidding. Keep going. Keep going.
It started with the idea of a whole life product that has guaranteed crediting rates and dividends tied to it. And the idea was, look, if you can build your own bank, your own account value, and over time, if you can easily borrow against it at a reasonable rate, then you can go use that money for outside things that might invest at a higher rate than your life insurance.
Okay, so that sounds awesome.
Yeah.
Why is it not awesome?
It's often sold to people that don't have the opportunities most of the time to go buy something with that leverage that you're using that's going to make a really tremendous impact. So, number one, if you're only contributing, I'll say $5,000 to $10,000 into your policy, there's not many things that over 5 to 10 years and that cash value's grown to $50,000 or $100,000 that you're going to be like, sweet, I want $30,000. Most people are going to use that to go buy their car. They're not going to go buy some investment that's going to, hypothetically positively arbitrage whatever your loan rate is there and earn 12 to 20%. Most people that are sold this are not in a place that they have all these excess funds to begin with. And when life happens, which life happens, let's say you start having more kids or you go buy a bigger house because your wife wants a bigger house, then your obligations start to get heavier. And what are the areas that you're going to start to skimp on? It's going to be your life insurance your product, right? And if you're somebody that's only contributing a small amount because that's what felt like was going to make you rich someday and that's all you had, when life gets expensive, your life insurance is the thing that usually they start pulling back on. And if you've already borrowed against it, you're just adding more leverage. You might lose your policy. You might have to pay taxes. So the problem is people don't manage their policies well enough. It becomes complicated, and it's not always most suitable for the people that are being sold it. There's also the tension of this is just one of the. It's often pitched by people where this is their primary tool in their tool shed of financial tools, and because of that, there's a stronger desire that this is the end-all be-all right solution for somebody to do.
Okay, so if you're being pitched infinite banking, is there a certain net worth you should have before it even makes sense?
I mean, I'm sure there. Yeah, I would say you should.
You're making 80 grand a year. Should you even
no.
be? I'm making 150 grand a year.
I
Should
would
look
not
at
tell
infinite banking?
anybody on any life insurance structure that if they're going to use it for cash value, they better be making $300,000 to $500,000 a year of income before you even think about it. You should be maxing out all of your retirement plans. You should be doing all of the true investment things and keeping investments and insurance until you become so wealthy or are making so much money that you're like, what other areas can I allocate funds to build more savings, right? That's when the conversation can at least start in a reasonable foundation. From there, I mean, I don't like seeing people contribute to any of these policies if they're not contributing more than, I'll say, $25,000, maybe $50,000 a year. Like, to me, it needs to be so impactful that if they can comfortably spend that or allocate that money to it, that it's going to turn into something that they could actually use tangibly in the future to make more big purchases. So most of the time, people that are well under that, the risk of life happening is too great to ever allow that to make sense, where if they couldn't afford that premium or if the policy underperformed, it's not going to impact their longevity of their financial plan in such a negative way.
If you put, let's say, $10,000 a year of premiums into one of these policies, how much of that $10,000 a year premium paid goes to the cash value of the savings account versus how much of that is a premium payment versus how much of that is fees?
Yeah, I mean, so it's dependent on product, and it's also very dependent on how the agent structures the policy. Like I said before, like you want to either structure a product for death benefit or for accumulation. If it's done properly, where you're reducing the death benefit to as little as possible, that's what's ultimately reducing the internal fees. And you can actually structure these things under reasonable assumptions still, where from a fee standpoint, it's not unreasonable. It's just you need a client that sticks to the plan, and it needs to be a proper structure where it's trying to reduce the fees as much as possible. And over time, I'd say somewhere in the 15 to 20 year range, it would the overall fees paid over that course of time tend to be equal now as, say, asset manager fee that would have otherwise made the same amount of fees over that course of time if you just invested it there, say for a 1% fee. And then in the future, those fees actually are less on the life insurance side than a managed account. You know, if it's a fixed 1%, that managed account's going to continue to grow. Their fees actually increasing the longer you go. So if and when it's done properly, it can be okay from a fee perspective, actually. The problem is you have lots of people, the barrier of entry to become a life insurance agent is very low, and there's a lot of people that don't know what they're selling. Right. So the structures can very easily become, hey, how do I make a commission off of this? Or how do I build this in a way that they're happy, but also I'm happy? And that's where the challenges come in. That's where the fees start to eat away at the amount of cash value you can grow.
Do you think that there's a lot of people that are under the impression that if they paid $10,000 in premium with the potential of drawing against that down the road, that let's say in 10 years there's $100,000 there that they could pull out? That's just the simplified math that they do, not knowing that some of this is going to death benefit, some of it is covering fees, and that $10,000 a year isn't going to equal $100,000 that I'll have available to draw against 10 years from now?
Yeah, I mean, in most cases, there's surrender charges that are early on a lot of these policies, so you would never want to borrow against it early on unless you have a certain rider that allows for an early cash value to be available. But in the most part, these are sold where surrender charges are early. You might put, in the same example, you put $40,000 in over 4 years, your cash value might be $5,000 because the surrender charges eat away at it. Now, that's different than, say, the internal. That would be like the net surrender value. It's different than the account value that might actually be earning credits. Over time, usually around the 10-year mark is when your premiums paid, if it's structured properly, are equivalent to the amount of cash value that's within the contract. So carriers are always going to make all their money up front on these things. That's the primary way that they
it's like almost money. Half to what 90% of the fees are captured in the first year or so?
There's a lot of the fees are early on.
Why don't they have the qualification of needing to be an accredited investor with insurance? Is it because it's not technically an investment?
Yeah, technically speaking, it's not
a
fixed life insurance product from a categories perspective. It's not a securities life insurance product, which is like a variable contract. And that's part of the struggle in our industry, to be completely honest, is the products, especially on the index platform. And I can be a fan of index products, so I'm not saying all index products are bad, but they're becoming so complicated that even subject matter experts in the field, it takes them a while to figure out what are the nuances of this contract that are baked into this illustration. Because it's our job to understand them and then be able to communicate that to a client. That's what we should be doing. Right. It doesn't always happen. A lot of the time an agent might throw numbers in a software. They know how to click the buttons to solve, and it's going to show you that income for life, and they have no idea how they got there.
Yeah, that's been done to me many, many times. Many times.
But incentive structure is a big part of this too, right? You know, you have, like when I became a CFP, I got my life and disability insurance license when I did that as well. I did it in 3 weeks, right? To his point, it's not a high barrier to entry to get it. And when you have young kids that are going out and doing it, it's very lucrative. It's like, oh, I have to study for a relatively easy exam, get it out of the way in, let's say, 30 days. And now I can go out and sell and make, multiple hundreds of thousands of dollars a year. The incentive structure is designed to sell products that aren't necessarily a good fit for the person. And so you really have to have a very high level of integrity in the insurance space to look at the client and what it is that they need, and then recommend a product like he does, recommend a product that fits what it is that accomplishes their objectives. Not to go in with what is the thing that's going to pay me the most amount of money, and based on that, that's what I'm going to drive my client into that, based on, let's say manipulating them into believing that they need something that they don't need, because the incentive structure is designed in a way to get them the most amount of money based on the thing that the insurance carrier is going to generate the most amount of revenue from.
Yeah, now it's making sense why infinite banking was blowing up on TikTok the way it was, because all the young kids got in. And
Yeah.
It's a great sell. Oh my gosh. I mean, the sell of it sounds phenomenal.
Yeah.
So what is the biggest lie in the life insurance world that you're willing to say publicly?
The biggest lie, that it's the greatest investment vehicle ever. Like, truly, that's too many people start an investment conversation because they can say they're a financial services professional, saying that life insurance is the first thing that you should be putting your money towards. That's not accurate at all. So, and a lot of it stems into some of the conversations we were having, it can start to get multiplied too. If you want to start using leverage, if you really want to get complicated, let's go borrow money to supercharge these contracts, and instead of you putting the money in, we're going to use the bank's money, and now we're using leverage on leverage, right? So that's where it can get really messy. Is if those policies underperform, it can get ugly. And the problem is you never know until you're in the situation. When you make the decision to move forward, it's based on a sheet of paper that projects out what all these values are going to be in the future. There's no index return that's ever produced the same number for more than maybe 2 years. I don't know. Has an S&P ever produced the exact same number 2 years in a row?
Yeah, that's right.
I have no idea. Probably not. But on an illustration, we're going to allocate funds towards this index and show the same exact number every single year for the rest of the contract. Like, that's not realistic. So a lot of the times the assumptions are not realistic. If you or anybody listening to this is getting presented a policy for accumulation and they're seeing on their ledger page income for the rest of their life, I would say be careful, because that's not realistic. And you can sort of do simple math, and if I had a presentation, I would show you. But if you just understand leverage, and if you've got cash value and you borrow against it and you're 80 to 90% levered on that cash value, there's going to be a column that shows account value. That's what it's getting credited off of. And then there's going to be a column of net surrender value. You're going to see that the net surrender value becomes so much smaller than the account value. Well, what is being assumed in that structure? We're assuming the account value, we'll say, is $2 million, and we'll say the net surrender value is $200,000. That account value earns 6%. Well, that's great. And we're assuming that loan is 5.5%. Every year, that account value is going to continue to go up. There's no negative arbitrage there. In reality, if you're at $2 million and there's only $200,000 of net difference, and you earn a zero that year because markets go up and down, you have a negative 5.5% interest loss to your overall cash value, and that's on the $200,000 delta. So you might have $50,000 or something left in that cash value, and that completely changes the longevity and projections of that policy. And if that policy lapses, you're in a lot of trouble. And people don't realize that. And that's where, on paper, if you're seeing your numbers get to such a low amount, and then all of a sudden they magically start going back up in the later years, you're like, wow, that's cool. I could never run out of money. All it's showing you is the math behind the arbitrage, where eventually you're out earning on that large pool what your net differential is, if that makes sense.
Got it. Okay, everyone, that was a lot of information. Make sure that if you have any friends that are asking you about insurance, that you are sending this video to them. Please leave in the comments if you thought this was valuable. That was overload. That was a lot of awesome information. If you guys are looking at insurance and you need somebody to talk to that's going to shoot you straight, Russell is your guy. We're going to provide his information in the description. And also leave a comment on what you want us to tackle next. What's an industry that we need to jump in on?
AI.
I'm not touching AI. Leave it in the comments. We will explore that next. Thank you guys. We'll see you next week.